How an ROIC tree shows a company's growth drivers and capital efficiency. Return on invested capital, return on capital, or return on investment are all interchangeable terms that focus on the same idea, measuring the returns on capital that a company can generate from their capital. The company's capital stems from its assets, liabilities, and equity that helps them grow their revenues. Those revenues or sales flow create more assets, cash flows, and profits that the company can reinvest for more growth. Think of it as a circle of life for a business. The basic idea behind the ROIC metric is the net operating profits after taxes compared against the company's invested capital. Building an ROIC tree. The easiest way to think about the ROIC formula is a version of the discounted cash flow model. The reinvestments help grow the value of the company. Let's look at a simple 5-year discounted cash flow model to look at the components. We will assume the following for our model. NOPAT growth equals 8%. ROIC growth equals 25%. WACC equals 7%. NOPAT in year 1, $100,000. Investment in year 1, $32,000. Free cash flow in year 1, $68,000. NOPAT in year 2, $108,000. Investment in year 2, $34,600. Free cash flow in year 2, $73,400. NOPAT in year 3, $116,600. Investment in year 3, $37,300. Free cash flow in year 3, $79,300. NOPAT in year 4, $126,000. Investment in year 4, $40,300. Free cash flow in year 4, $85,700. NOPAT in year 5, $136,000. Investment in year 5, $43,500. Free cash flow in year 5, $92,500. As we can see from above, the cash flows grow exponentially as the company reinvests at a higher rate over the years, growing the revenues exponentially, all of which flows to the free cash flow. It is a virtuous circle. But the question remains, what drives those returns? The reinvestments drive both revenue growth and cost decreases in better inventory buying or a quicker cash conversion cycle. All of these investments drive better operations for the company, creating growing cash flows. The value Microsoft creates each year comes from the cash flow it generates and the change in its continuing value. Each section of the ROIC formula stems from a different part of the income statement and balance sheet. NOPAT focuses on the income statement, and investments focuses on the balance sheet. Building an ROIC tree helps us understand the inputs for each segment of the formula. By creating a tree branching away from each line item, you see how different items drive the company. For example, sales flow to the operating margin, which flows to the NOPAT. At the same time, the inventories flow to the working capital, that flows to the company's investments. If we look at the investments a company such as Microsoft makes, we need to take into account the items including accounts receivable, inventories, accounts payable, goodwill, intangibles. And if we look closer at a few of these, we find accounts receivable. This account tracks customers receiving a product but hasn't paid for the product. Think about financing the Azure product, for example. Microsoft's balance on its balance sheet is money owed to them, and when they receive a payment, it reduces the balance. Inventories. For Microsoft, this line item contains raw materials, work in progress, and finished goods, all of which helps drive the revenues for the company, albeit on a smaller scale. Microsoft grows most of its revenues from Azure and SaaS businesses such as Office products. It doesn't require much in the way of inventories to grow revenues. Considering Microsoft's business, let's look at the list above and compare that to our ROIC tree. What do you think drives the investments? The large majority of the company's working capital contains goodwill, intangibles, net PPE, and accounts receivable, minus the accounts payable. As we can see, debt has no bearing on the working capital investments of the company, which makes sense for Microsoft. Another consideration is thinking about items such as R&D. Most companies expense their R&D, plus their SG&A. But one could argue that they are working capital investments for tech companies. As the nature of businesses has changed, the accounting rules have not adapted. Companies such as SaaS businesses like Shopify, Netflix, and much more expense any R&D, but they are capital-light companies. Diving deeper into their financials, we can see they don't require much in conventional working capital to grow revenues. Rather, innovations or products developed from R&D guide the growth. Think about Apple and the creation of the AirPods, which help Apple grow more revenues. But getting back to the ROIC tree, think about how accounts receivable helps grow the investments of Microsoft. As the company receives payment for their receivables, it reduces investments but increases revenues. This grows the ROIC of the company.